The impact of stablecoins on monetary policy and financial stability. So far, we've defined a stablecoin as a cryptocurrency that keeps its value stable in relation to a pegged external asset. The objective of stablecoins is to minimize price volatility, which is achieved by maintaining price consistency with respect to one or more of the following things: a specific fiat currency, for example Great British Pounds; a currency combination, which is a basket of fiat currencies, for example Great British Pounds, US dollars and euros; and a valuable commodity, for example gold. In light of the fact that volatility bothers most parties, especially major financial players, it is also reasonable to surmise that a stablecoin's main objective is to counteract the volatile nature of most cryptocurrencies. In this video, we will examine the impact of stablecoins on monetary policy and financial stability. The economic consequences of meddling with a currency's supply are severe. Stabilization necessitates the creation of money out of thin air to meet the surge in demand and keep prices stable. According to the Austrian School of Economics, this type of money creation is the source of the business cycle. As a result, even if purchasing power stability is achieved, it will be at the expense of overall economic stability. Hence, in this video, we will examine stablecoins and the economy through two different lenses to see how stablecoins affect monetary policy and financial stability.
The impact of stablecoins on monetary policy.
A hypothetical scenario in which stablecoins become an alternative store of value would have implications for monetary policy transmission and other related concerns. Let's take a closer look at some of these consequences. Number 1. Policy constraints. A non-interest bearing stablecoin could theoretically impose a zero effective lower bound on policy rates. Widespread investment in non-interest bearing stablecoins may encourage asset substitution away from assets paying negative interest to the point where further reductions in key policy rates do not translate to other interest rates in the economy. Number 2. Impact on monetary policy transition via banks. The widespread use of stablecoins as a store of value may impact the stability and cost of bank deposit funding, posing challenges for banks' ability to intermediate. Because the global financial system is based primarily on banks, changes in the structure and strength of bank balance sheets can have an impact on monetary policy transmission. Number 3. Liquidity and money markets. Stablecoins may impact the demand for central bank liquidity and, as a result, the ability of central banks to control money market rates. The need to clear payments in central bank money and absorb liquidity shocks caused by fluctuations in banknote demand drive demand for central bank liquidity. The impact of stablecoins on central bank reserve demand would be determined by the specific design of the stablecoin as well as the type of collateral used. Number 4. Safe asset demand. Stablecoins collateralized by high-quality liquid assets, for example tokenized funds, may increase demand for safe assets, potentially influencing asset price formation, collateral valuation, money market functioning, and monetary policy. Suppose that depositors switch from bank deposits to stablecoins. The demand for secure assets may increase if the stablecoin arrangement includes a large portion of such assets as collateral. Number 5. Exchange rate channel. The widespread adoption of stablecoins as a new payment method may have an impact on the exchange rate channel of monetary policy, making it more difficult for monetary policy to exert control over domestic developments, as in the case of dollarized countries. Most stablecoin solutions are centered around USD and are suitable for real-world usage in domestic economies. Multi-currency stablecoins are designed to be a more inclusive, locally familiar medium of exchange that limits foreign exchange risk and exchange fees, more like a Ghanaian stablecoin in cedis or a Pakistani stablecoin in rupees. In practical terms, let's take the euro as our sample fiat currency. The euro is a global reserve currency and is thus likely to be included in stablecoin currency baskets. This may affect the exchange rate channel in the case of multi-currency stablecoins. Next, let's discuss some possible impacts of stablecoins on government-issued fiat currencies. The impact of stablecoins on financial stability. If a given stablecoin structure is fragile, then its connectivity with financial systems may pose risks to financial stability. The following slides will focus on the two most significant risks: the risk of a liquidity run, hampering the operation of a stablecoin arrangement, and the risk of contagion to the wider financial system from a faulty stablecoin arrangement. Number 1. Liquidity run. The value of stablecoins may be vulnerable to the risks associated with investing in non-zero risk financial assets, such as credit liquidity, market, and foreign exchange risks. An important question to consider regarding financial stability is who ultimately bears the investment risks. Suppose the stablecoin arrangement does not guarantee a fixed value for the stablecoin. In that case, the value of the stablecoin will fluctuate in tandem with the value of the collateral, and the stablecoin is functionally identical to a fund share with the price equal to the net asset value of the fund. In this case, the end user is the bearer of all risks. Runs on stablecoins may occur if the end users lose trust in the issuer or its network. This could occur, for example, if an adverse event occurs, such as a cyber attack on the system or wallet theft, such as a realization, could result in significant redemptions, similar but not equivalent to withdrawals of stablecoins. Number 2. Contagion effects. In the event of a run on a stablecoin designed to be used as a payment method and an alternative store of value, liquidating assets to cover redemptions could severely impact the financial system. It should be noted that shocks to the stablecoin arrangement in emerging markets with inadequate institutional capability to handle operational mishaps, for example, could have a knock-on effect in advanced economies, which house the majority of the pool of collateral assets. Finally, the implications of stablecoins on monetary policy and financial stability depend on the specific scenario for stablecoin adoption due to their specific features and user demand. We hope you've enjoyed this quick run through on the potential for stablecoins to impact monetary policy and financial stability. The next video in this series will examine the impact of stablecoins on the general economy and the possible implications of the widespread use of stablecoins for payments and day-to-day transactions. Disclaimer: this series is intended solely for informational purposes and should not be considered trading or investment advice. Nothing herein should be construed as financial, legal, or tax advice. Trading or investing in cryptocurrencies carries a considerable risk of financial loss. Always conduct due diligence. For more in-depth information and high-quality materials on stablecoin regulations, click the links in the description below or visit our website at defi-planet.com.